Recently, I came upon a really interesting question. Is CPF a Ponzi scheme? When I tried searching for answers, I found a few old blog posts claiming that CPF is just a big Ponzi scheme run by the government. Basically, the claim was that the payouts to the older generation were coming from contributions from the younger generation. And in order to make it last longer, the government is postponing CPF withdrawals while increasing the minimum sum every year. Now, for the record, I don't believe that CPF is a Ponzi scheme, yeah. I believe it's a good social security scheme to make sure people are saving enough money for their retirement. But here comes two important questions. One, how is CPF able to keep paying a fixed interest of 2.5 to 6% every single year? In 2021, they paid out $18.3 billion worth of interest. Where did all that money come from? Second, how sustainable is CPF? For example, if touch wood, everyone withdraws whatever they can from CPF, or if Temasek keeps losing money on China and crypto companies, will CPF run out of money one day? So, in this video, I will try to answer all these questions and whether you should be worried or not. In return, I would greatly appreciate it if you can help to tap the like button and subscribe if you haven't done so. In return, I will show you a cute dolphin. Alright, let's jump straight to the first question. Where did all these CPF interest come from? Did they print it out of thin air? Not really. The interest actually come from investments. So, I'm sure you have already heard of Singapore government bonds, like our Singapore Savings Bond, Singapore Government Securities and Treasury Bills. But besides these three bonds, there's actually one more government bond, and that is Special Singapore Government Securities, or SSGS. Unlike the three bonds that are available to the public, the special thing about this special bond is that it's only available to the CPF board. So what happens here is that the government comes up with the SSGS bonds, then CPF board invests our CPF money into SSGS. This money then goes to the government, which is then put together with the rest of the government money, like the proceeds from issuing SGS, government surplus and land sales. Then a big part of this money will be transferred over to GIC to be invested. What? GIC? I thought Temasek is investing our CPF money? Well, no. This has been made very clear already. Temasek does not manage our CPF savings. It's actually GIC who's investing our CPF money. But wait, what's the difference between GIC and Temasek then? I thought both of them do investments for Singapore? Sort of, but they have very different goals. For GIC, their goal is to achieve good long-term returns, preserve and enhance the international purchasing power of the government's reserves, while Temasek's goal is to maximize shareholder value over the long term. In this case, the shareholder is the government. Both goals sounds very similar leh. Got say like no say leh? Okay, there are three main differences between the two of them. First, GIC is treated as a fund manager for the government. They receive money from the government, invest it and return the profit back to the government to pay for their spending. While for Temasek, they are treated as a normal investment company. They don't really receive money from the government. Instead, they receive money from their own investments, bonds and borrowings, and they distribute their profits to the government in the form of dividends and taxes. Second, GIC investments are a lot more low risk, low reward compared to Temasek. For example, GIC has an annualized 20-year rate of return of 4.2%, while Temasek is at 8%. Third, GIC portfolio focuses on non-Asian countries like the US, Latin America, UK, Europe and so on, while Temasek focuses mainly on Asian countries like Singapore and China. So those are the differences between GIC and Temasek. But enough of them, let's go back to our CPF money. Quick pause. New year, new me. Webull has recently added two new features. The first feature is index options trading. So you can now trade options on your favorite index funds. The second feature is mutual funds trading, which means that now you can buy mutual funds and park your idle funds into low-risk funds to earn a yield. In their latest promo, Webull is giving out $150 cash voucher. To get it, all you need to do is deposit 2,000 SGD, buy one US stock or an ETF with a minimum transaction of $100, subscribe to one mutual fund, and buy one US option, all while maintaining a $2,000 net account value for 30 days, and you will receive $150 cash voucher reward. So if you are interested, you can sign up using my link down below. With that being said, let's get back to the video. So as mentioned earlier, the government gets our CPF money by issuing SSGS to the CPF board. The money is then pulled together with the rest of the funds and invested by GIC. And because SSGS is a bond, it is paying a coupon rate that is pegged to CPF interest back to the CPF board. So that's where CPF gets their interest from. But here's a very interesting question. Since GIC is responsible for investing our CPF money, what happens if GIC, touch wood, loses money? Will our CPF run out of money, jibaboom, and die? For this, you don't have to worry, because GIC is still making money, though the long-term returns have been slowly falling from 5.8% to 4.2% now. But don't worry, this is real returns, meaning it's the final return after adjusting for inflation. So the actual return is actually much higher than this. But let's say if GIC really did start losing money, wouldn't CPF end up not having enough money to pay interest, or even worse, run out of money? For this, you also don't have to worry, because the returns are guaranteed by the government. Oh, I see. Now I'm sure that our CPF is safe. Oh wait, do you say that it's guaranteed by the government? The same government who's keeping all our CPF money? It's like when your mom takes your ang pao money and guarantees you that she will pay you back when you are older. We all know what happened to that ang pao money. But as to whether we can trust the government's guarantee, as the crypto bros put it, don't trust, verify. So for this, there are two possible sources that are backing up the government's guarantee. First, GIC financial statements are audited by the Auditor General. The Auditor General is not controlled by the government, meaning they are independent from the government, and the position is safeguarded under the Constitution and the Audit Act. This means we can trust their audits. Second, the Singapore government has been given the strongest credit rating by international credit rating agencies, which shows that Singapore has strong credit worthiness and minimal probability of default. Or as Deputy Prime Minister Tharman puts it, this is a solid guarantee. Solid until cannot solid. But this still doesn't answer the question, how can the Singapore government guarantee CPF interest payment if GIC is losing money? The government says that they have a substantial buffer of net assets to ensure that they can meet their obligations, and their balance sheets are well in excess of their liabilities. Or in simple terms, the government got a lot of money lor. But how much money do they have? Okay, there are three organizations that are managing Singapore's reserves: MAS, GIC, and Temasek. MAS is holding about $400 billion foreign reserves. Temasek has $403 billion as of 31st March. And GIC doesn't really publish how much they have. So is it because they have something to hide? Don't simply say later the Mita catch you, then you know. The reason they aren't showing is because it is not in the national interest to publish the full size of the reserves. Because if they did that, it would make it easier for the markets to attack the Singapore dollar. The only thing we know is that they are managing over $100 billion in assets. But Forbes estimates that GIC is managing about $744 billion US dollars. So in total, we will have well over $1.5 trillion in our reserves. What lah? But Bloomberg reported that Singapore is forecasting a third year of deficits. Okay, for this, we don't have to worry too much, because most of these losses are due to COVID, and things are definitely getting better now. Add on to the fact that the government is raising GST to 9%, which will improve their revenue. Then you might ask, if the government has enough money to pay our CPF interest, why do they keep raising the minimum sum? For example, back in 1995, the full retirement sum was just 40k. But by 2027, the full retirement sum goes all the way up to $228,000. This means that the later you turn 55 years old, the more money that you have to lock up in CPF. Okay, the reason this retirement sum is going up It's not because the government wants to lock up your CPF money, yeah. The reason it is going up is because they want to keep pace with inflation. And if you think about it, because CPF SA is giving 4 to 5% interest, it is actually growing faster than the minimum sum, which is growing at around 3 to 3.5% rate. Also, technically, it's not locked up. If you want, you can invest your CPF SA money to earn a higher return, as long as it's above 40k of course. And with this lockup, you are enrolled into CPF Life, which gives you a lifelong payout, no matter how long you live. So even if you live till 1000 years old, you will still get CPF payouts. And last but not least, after you pass away, the CPF money that's left will be passed down to your descendants. So in summary, you don't have to worry, yeah. CPF is not a Ponzi scheme. There are lots of rules and safeguards in place to make sure that CPF is able to do its job well, which is to help Singaporeans prepare for their retirement. Anyway, that's all for this video. Hopefully, you find it useful. Like, share and subscribe, as I'll be posting new videos every Monday, Wednesday and Friday.